Hi guys, it's Ian Coleman from PIA First. It's Saturday the 11th of April and we're going to do a quick video presentation on euro dollar. I would suggest that if you haven't looked at it already, if you go back and look at the dollar index video, because although the bias is still bullish in the dollar index, we have to express a little bit of caution going into next week with the index stalling at Fibonacci confluence area. Going back to euro dollar, we've seen some aggressive selling. We always like to start with the higher time frame charts. So here we're just looking at a euro dollar monthly chart. Our long-term bias is still for a move to the downside. Okay, this aggressive sell-off has seen various formations break. We've seen an ABCD formation or target area break to the downside. We also broke out of a triangle formation to the downside. We've broken through the 61.8% Fibonacci confluence area, which was basically close towards the 127.2% extension level. So now we think that we're going to be looking towards this area, this Fibonacci confluence area, which is a 78.6% pullback and a 161.8% extension. A lot of traders, a lot of analysts are getting their head round parity for euro dollar, and I think over the medium term or the long term we will push back down towards those levels. We can also note that coming back here, the latter end of 2002, a lot of price action around this big figure. Over the shorter term, we can do a candle count here. We've got 1, 2, 3, 4, 5, 6, 7, 8, 9, not including this month, 9 negative candles in succession. Now there is something in technical analysis called the rule of 9 that dictates that after 9 positive or 9 negative candles, completed candles, you should break that sequence. So in other words, what the rule of 9 says, that more often than not, and that's what technical analysis is based around, okay, more often than not, after 9 negative candles, we will see a positive candle. Now we can look at the April candle formation as it's forming at the moment, and we're still holding inside March's bearish candle. We're only going to have to move very slightly or close very slightly to the upside. If we look at the opener was at 107.30. We're currently trading at 106 the figure, so we're only going to have to move 130 points to the upside for this candle, or just over 130 points for this candle to close positively this month. What I think is going to happen, I think we're going to push a little bit further higher, then we're going to have a correction back up, and we're going to post an inside bullish harami candle, but it's basically going to highlight indecision. It's not going to highlight a change of trend. If we break down to the 2-hour chart, we can see that from basically the sort of 9th of March, we had this choppy price action, posted an ascending triangle formation that has a bias to break to the upside, but it didn't. We've broken to the downside. Okay, and if we look here, we also had an outside bar, one of our favourite chart formations, or one of my favourite chart formations, that highlights that the bias is turned again to the downside. Holding the Fibonacci extension levels quite well. Small correction overnight on Thursday, and then continued selling Friday morning, and then some consolidation. Again, I'd ask you to look at the dollar index video to fully understand our bias here. Our bias is still bearish, but we do need to see a break of Friday's low really to continue the downward move towards sort of 104.30, which is this 261.8% extension level. Another mild note of caution, okay, on the euro dollar is that we have posted a DMARC exhaustion count, and that was posted on the daily chart on the 7th of April. However, DMARC dictates that even though it's a 13 count exhaustion count, that you actually take the stop from the lowest candle in that formation. Okay, and that was actually posted. We go back to a daily. that was actually posted on this candle here, okay, which was the 13th of March. So you basically take the high and the low from that candle, and that then becomes your stop, and we can see that that's obviously below this 261.8% extension level. In fact, the stop for the DMARC exhaustion count is not seen until 102.89. So, not to make a call, but if our bias remains bearish, okay, we're continuing to post negative days. You can actually see by this chart here. I'll just get this out of the way. We posted 5 down days in succession last week. Okay, really need to see a break of Friday's low to take us down to this level, where we might post a double bottom with some divergence, okay, and then get that upward correction to then post the inside monthly bar to satisfy that rule of 9. So like I say, the immediate bias going into next week is bearish. We'll break of Friday's low, taking us down to this previous lows around about 104.30. Would it not expect too much of a push through that double bottom or potential double bottom? Look for divergence. In other words, the chart makes a lower low, the oscillator makes a higher low. That's divergence. Then look for reversal candles around here to take us back up, maybe, you know, in the middle of next week. Okay guys, thanks very much.